Welcome to ETF Market Insights, a weekly show focusing on the evolving world of ETF investing. Each Friday, a new panel of thought leaders aims to provide investment education and insights, with the goal of helping you become an informed investor. Make sure to visit youtube.com/ETF Market Insights to watch previous episodes. And remember to hit subscribe so you receive a notification when we post new content and when we go live each Friday. Thank you for joining us today. Let's get started.
Welcome back to ETF Market Insights. I'm your host, Erin Allen with BMO ETFs. And today we're going to be diving into the world of infrastructure investing. And we're going to discuss why you as an investor might consider this type of exposure in your portfolio, given what's going on in the markets and the economy today. So infrastructure investments can provide a lot of benefits. They can be resilient in troubled markets. They can provide consistent cash flows. The industry itself offers diversification benefits. And last but not least, there's lots of opportunities coming about in the industry that's being driven by policy around the world, which we'll also touch on today. So a quick reminder that today we're not providing investment advice or recommendations. Our channel is all about providing education to individual DIY investors here in Canada. Today, I have the pleasure of being joined by my colleague Vishal Bhatia, who is a portfolio manager with BMO ETFs. Vish is also a CFA holder. Has been with BMO ETFs since 2016 and has over 2 decades of experience in the industry. So thanks, Vish, for joining me today. It's good to have you back.
Thank you, Erin. Glad to be here.
Let's dive right in and get on to the topic of infrastructure here. Just to kick things off, I thought we could review sort of the overall benefits of investing in infrastructure assets. Why should an investor consider an exposure here?
Sure. Well, I mean, one of the reasons why infrastructure assets are, potentially very attractive to investors is that the underlying assets are essential to the functioning of modern society. So if you think about structures such as roads and bridges, power plants, water treatment facilities, telecommunications networks, these are the kind of things that really, the demand for these products doesn't really, wax and wane very much depending on economic cycles. And they're very long-lived assets with natural barriers to entry, given that they've got very high upfront costs associated with them. And that makes them potentially very attractive to investors who want to get the associated cash flows from these assets and benefit from the long-term growth. So if you want to drill down a little further into what the characteristics of infrastructure asset returns are like, or what makes them attractive, the stable cash flows being generated from the operation of infrastructure assets is very attractive to investors looking for some predictability of cash flows. And that stability or predictability comes from the nature of the assets, in that the demand does not vary much depending on the economic climate. People need to, get water or drive on highways, use the electricity grid, no matter whether, you're in a bull or a bear market. And that makes it a good source of income for investors, especially during periods of market volatility. Another factor that makes infrastructure investment quite attractive to investors is the inbuilt inflation protection that is often baked into the contracts in the infrastructure assets. So, for example, in the pricing contracts associated with toll bridge, for example, there is typically an inbuilt protection mechanism against inflation. So should inflation rear its head, the fees will rise and revenues will rise to compensate. So that can be or serve as a very good hedge against inflation, given that they have contracts typically linked to inflation. So that protects investors from the effects of rising prices over time. Another thing that is in the favor of infrastructure investment is long-term growth associated with the very long lives of the underlying assets. It's not unusual for a bridge, for example, to have a lifespan of 50 years or more, and as there's an increased trend towards urbanization and increased traffic that we all are pretty angry about, but that benefits. That supports the growth associated with revenues linked to assets like bridges, for example. And because of the fact that a lot of these infrastructure assets are a little bit outside of the typical economic cycles. The return streams offer diversification benefits to stock and bond investors in that asset returns linked to infrastructure are often quite uncorrelated or low, correlations to stock and bond markets. So by inserting infrastructure assets within the context of a broader portfolio, you can often, reduce the overall risk of a portfolio. So that's another feather in the hat of infrastructure investment.
That's a great
one other point to it. Oh, yeah, sorry,
Yeah.
Erin, just one more point I forgot to mention, which would be, so that's all great. That sounds like, a perfect scenario. Sounds like something for everyone, but there is, one potential caveat or risk that one needs to be aware of when investing in infrastructure, and that's specifically when investing in infrastructure directly. It's not that easy to go out and buy a share of a bridge or a toll road or a water treatment plant and so on. So investing in infrastructure directly is fraught with complexity and is often reserved for, very large institutional type investors. And also, one of the potential downsides associated with that, in addition to what I just mentioned, is the potential lack of liquidity associated with investing in infrastructure directly. And so that's why accessing infrastructure within a fund structure then democratizes access to this very attractive asset class, because you don't have to deal with all of the red tape and the high hurdles to investing in and benefiting from getting some of the cash flows associated with the underlying assets.
Yeah, that's a good point. I think like when we launched our ZGI, our infrastructure ETF back in 2009, it was one of the first ones we listed. And I think that's exactly why, is because we saw that need to really democratize investing in infrastructure and make it simple for investors. And definitely has done that. When I think about infrastructure, and you touched on bridges and roads and airports, that's sort of what I think about, but there's so much more to it, and there's other industries that investors might not even think about when they hear the term infrastructure. So walk us through sort of what are the different types of infrastructure investments or subsectors in the space?
Sure. Right. Well, there are many different types of infrastructure investments, and of course, as I mentioned before, as you mentioned, we think of some of the big things like bridges and roads and so on. That also encompasses things like airports and railways. So that's what I categorize as, transportation infrastructure, critical for the movement of people and goods, and involved in the logistics of getting all of the, stuff from one place to another. So that's a growing sector due to the increasing urbanization and globalization. You've got energy infrastructure, so that would be, investments in power plants, transmission lines, pipelines, and that's, very key for the production and distribution of electricity and other energy sources. A subsector of the energy space would be one that's definitely having a moment in the sun. Sorry for the pun there, but renewable energy. And this includes investments in solar, wind, other renewable energy sources, and that's a growing sector due to the concerns that we all have about climate change. Water is another sector. Water treatment facilities, dams, canals. It's essential for providing clean drinking water to homes and to businesses, and it's a limited commodity, and so having the associated infrastructure around that to provide clean drinking water is another area of focus in infrastructure. Telecom or digital infrastructure as well is one I think that we can all appreciate given how connected we all are now, and the voracious appetite out there for being interconnected to everything, the Internet of Things, as it were. And so that includes investment in cell towers, fiber optic cables, data centers, the cloud. So all of this telecom infrastructure, it's really essential for the transmission of voice, data, and video, and so on. And it's one more, too, that maybe people don't think about as much when it comes to infrastructure is what we would call social infrastructure, which would be infrastructure in other critical assets like hospitals and prisons. So that's another, essential bit of infrastructure that keeps modern society functioning as we would expect.
Yeah, so anything that's like a necessity in our the way we do things, right? Like it seems like infrastructure is just I've heard it referred to as the plumbing of our society, and that really stuck with me. It's anything like
Exactly.
that. How does infrastructure investing compare to other asset classes in terms of like risk and return historically? When does it generally do well? I think it's safe to say it's more of a defensive exposure, but walk us through that.
Yeah, it is certainly more of a defensive type exposure, and I don't want to paint all infrastructure with the same brush because there are different niches and different unique exposures. But if we just speak about broad infrastructure encompassing the various sectors that I mentioned, you can kind of think of it in terms of just high level risk and return, whereas stocks you might categorize in terms of risk as medium to high risk and offering the opportunity of potentially high returns. And whereas bonds would, in general, offer somewhat lower risk, and accordingly low to medium return expectations. The infrastructure space sort of falls in between that, sort of in between stocks and bonds. So low to medium risk, and that's owing to some of the characteristics that I mentioned with respect to the predictability of cash flows, the fact that the underlying assets and the demand for those services and assets is often severed from the economic cycle. However, the returns associated with those assets can often be medium to high, given some of the inbuilt inflation protection, for example, that I mentioned, and some of the big mega trends that are driving demand for the space. So really, broadly speaking, I would say that the infrastructure investing space falls in between stocks and bonds in terms of risk and return. So that could be a good option for investors who are looking for something that's relatively stable with the potential for higher returns than bonds.
That's a really good way of putting it. And you touched on this, but of course, inflation is still around, coming down, but still at elevated levels. We're not quite out of the woods yet. Walk us through a bit more in terms of how infrastructure investing can be a good spot to be in times of inflation.
Yeah, I mean, I did allude to it, but just to elaborate a bit more. Given that infrastructure assets are essential services which are in demand regardless of the economic climate, roads, bridges, they still need to be maintained and repaired even if inflation is high. And given that the contracts that these assets have, these companies that own these assets have with the users, they're very careful about ensuring that that their costs are covered and that they have oftentimes a guaranteed margin of profit above the cost of operating, and it's linked to inflation explicitly, so that the cash flows from these assets will increase in line with inflation, which offers opportunity to protect investors from the effect of rising prices. So power plants, for example, many of them have contracts that stipulate that they're going to be paid a certain amount per unit of electricity produced, regardless of the cost of fuel. And this means that the power plant's profits will increase if inflation causes the cost of fuel to rise. And as well, I guess another aspect that helps the assets be a defensive play in times of inflation is the fact that the assets themselves are often very long lived. It's not practical, to go out and build a new electricity grid or bridge every few years and upgrade it like they do with software or whatever. So they often have very, very long lifespans, 50, 60 years or more. And so investors can often benefit from that and ride the coattails of that long-term growth in demand for these assets and the inflation-linked cash flows. So, like, for example, if you look at like water treatment facilities, the demand for water treatment facilities, it's expected to grow as the population increases and the world becomes more urbanized. So that type of growth will provide investors a long-term source of income and further protection against rising costs. And then I guess lastly, again, is the diversification benefits. Again, given that they're not as well correlated with other asset classes such as stocks and bonds, so that could reduce the overall risk of a portfolio, meaning that if stocks and bonds are both declining in value because of inflation, double whammy, as we saw in recent years. Infrastructure, on the other hand, might be able to hold or preserve its value, or even appreciate in some cases.
Okay, and then how are different policies and like the political? Let's talk a little bit about the political landscape. We had Biden's infrastructure plan. Was it 2 years ago? walk us through how that's sort of driving greater opportunity in this space as well.
Yeah, I guess there are a couple of big forces at play in affecting the demand for infrastructure investments and the outlook for infrastructure investments. You mentioned Biden's Build Back Better plan, so it's like a mega plan, a multi-billion-dollar plan to fund infrastructure in the United States, both to repair the rotting, aging infrastructure, as well as build outright new infrastructure and support all kinds of, renewable initiatives and so on. So that's certainly been a tailwind for the space. And in Canada as well, under Justin Trudeau's government, recently it was announced as well to a multi-billion-dollar package focused on supporting or the initiative to build infrastructure. So certainly in the political landscape, there is broad-based support for renewing our infrastructure and building and allocating funds towards new infrastructure. And in recent years too, given the COVID-19 pandemic, that also had an impact on infrastructure investments, kind of in the opposite way, in that the government had to divert resources to other priorities that were more important, obviously, such as healthcare and economic stimulus. However, it also highlighted the importance of infrastructure. We all witnessed all the logistical bottlenecks disrupting the flow of goods and people from place to place, and so that should also provide a clear impetus to increase investment in infrastructure in the coming years. Another political risk, let's call it, the war in Ukraine, is having a significant impact on infrastructure investments, as governments are looking to increase spending on defense and security, as the war is highlighting how potentially insecure or how exposed, let's say, the global agricultural food chain is, for example, and all the logistics associated with that. So that may as well, impact infrastructure investment, ensuring that we have resilient infrastructure in place so that vulnerable critical infrastructure is less susceptible to attack. Okay, and then of course also front and center, especially in this hot summer, is the climate crisis. That's also having a major impact on infrastructure investments. So everybody can appreciate it. This one inherently, and governments are increasing spending on adapting to this new landscape and attempting to mitigate the effect of climate change through robust decarbonization efforts. And there's like the net zero initiative too, that around the globe, countries are trying to commit to implementing measures to reduce the carbon impact, attempting to move to net zero emissions by, I think, 2050 it is. So that's going to be a huge supporting factor. This is not a next year or the year after story. This is a multi-decade tailwind to support the space, because there's going to be massive investment in infrastructure in order to address these really challenging climate change initiatives, and a lot of focus paid on renewable energy, water infrastructure, and so on.
Yeah, I think that renewables theme within infrastructure is definitely an exciting one, and one to watch with all of these policies and changes going on around the green transition. Let's turn to ETFs and bring it back to ETFs here. What are the different sort of factors that investors should be considering when they're going to select an ETF, an infrastructure ETF?
Right. Well, I mean, an ETF is just a container for underlying assets. So I think it's important to know what underlying assets are inside of an infrastructure ETF. And there are different ways to get exposure to the infrastructure theme. Some of them are very broad-based, covering many different sectors, and some are a little bit more focusing perhaps just on one area, like water or renewable energy or whatnot. So the first step is to understand what are the underlying assets, and that'll give you an idea of the types of infrastructure projects that the ETF is exposed to, and whether that gives you the type of exposure that you're seeking to get access to. Another would be is the exposure pure play or not? So some listed companies that trade on exchanges may own an interest in an infrastructure asset, but may not be a direct beneficiary of the cash flows emanating from or being originated from that asset. Whereas other companies may own and operate the underlying assets and be a direct beneficiary of the cash flows. So, our ETF, which we'll talk about a bit later, is in the latter group, which is to say it's a pure play fund that provides exposure to companies that derive the majority of their cash flows from the direct operation and ownership of infrastructure assets. So that can give folks access to, I guess, the better aspects of what infrastructure has to offer. If you were to invest directly in it, you can access many of those same benefits within an infrastructure ETF by focusing on something which is pure play. Another factor when considering or evaluating infrastructure ETFs would be liquidity, which I mentioned a bit before, but the underlying asset pool, all these hard assets like water treatment plants and whatnot, if you're to invest in them directly, obviously, it's not necessarily the most liquid, easy to enter or exit asset class outside of an ETF structure. But within an ETF structure, if you own listed exposure, that definitely lowers the bar for liquidity. It makes it much easier to enter in size. And so that could be of great benefit to investors, not only retail investors, but also institutional investors who, need to enter in, significant size. And so evaluating the liquidity of the ETF is very important. And as is the case with all ETFs, you don't evaluate liquidity of an ETF just by looking at on-screen volume. There are other measures that one can look at. I won't go into that now, but evaluating thoroughly and correctly the underlying liquidity of the assets within the ETF will allow one to determine whether an infrastructure ETF is, a suitable vehicle for investment. Okay. And then, lastly, of course, just as is the case with evaluating any ETF, you want to ensure that, you understand the risk profile, the scenarios in which a fund has generally in the past done well and vice versa, and understand the risks associated with infrastructure investing, before investing in an infrastructure ETF or any ETF for that matter.
Yeah, I think looking at cost always an important factor, and that bid-ask spread on an ETF, and I'd say maybe finally just active versus passive, right? Are you looking to have an active manager making a call on this, or are you looking to invest in more of an infrastructure index? So those are all right, Vish. And we had an episode a couple of weeks ago where I had ARK Invest on, and they talked a lot about artificial intelligence and how it's really driving opportunities across sectors. So I wanted to ask you, how do you think AI is impacting the infrastructure industry in particular?
Sure. Well, I would say, yeah, indeed, AI is impacting all industries now, and it's in particular having a major impact on the infrastructure industry, just generally by offering the opportunity to improve efficiency, safety, and sustainability of the underlying infrastructure assets. So some examples specifically with regard to predictive maintenance, let's call it. So it's currently being used in the infrastructure space, the AI is, to analyze data from sensors and other sources to predict when infrastructure assets are likely to fail. So this is sort of, approaching maintenance on the front foot rather than on the back foot or on a sort of a dumb schedule, but actually by looking at analyzing incoming data in order to predict when infrastructure assets are in need of preventative maintenance. So that can avoid costly repairs and downtime. It's being used to predict when bridges are likely to need repairs, so that the repairs can be scheduled before the bridge fails or presents a danger. So that could, if you just extend that type of thinking across the board, it's perhaps an intelligent way to utilize, the past history and then incorporate data from sensors to incorporate new information and make an intelligent prediction about, what areas might require some sort of maintenance sooner rather than later. Automation, of course, can benefit from AI. And so, things like traffic control, power grid management, and water treatment are also benefiting from the rollout of our AI technology, and it's being used already to control traffic lights on the traffic grid in a number of cities. And theoretically, that should result in something that we will all appreciate: the reduced traffic congestion and improved air quality as a sort of a secondary benefit. Less idling around and more pedal to the metal. You can keep moving, right? Smart sensors are being deployed all over the place on these assets in order to monitor the efficiency and performance of these infrastructure assets and identify problems, and then optimize and feed back into the computer let's say DNA that keeps the operations running to monitor the condition of bridges and other infrastructure assets. And then robotics as well too, of course. We've seen robots and what they do in the Amazon warehouses perhaps, but also this same sort of AI powered robotics technology can be used within the infrastructure space to do dangerous and repetitive tasks in infrastructure construction and maintenance. So that can ultimately improve safety and efficiency. So, as I mentioned, it's just being used across all sectors, but certainly it's being used in the infrastructure space in an increasing number of ways.
Interesting. Yeah, it's always good to think about how technology is evolving in that space too. Want you to take us through our 3 infrastructure ETF options that we have at BMO.
Sure. Well, we have a number of ETF vehicles to provide access for investors to the infrastructure space. The oldest one that we offer is perhaps the most broad exposure, and that's the BMO Global Infrastructure Index ETF with the ticker ZGI. And that offers pure play broad access across numerous infrastructure sectors, and it's focused on companies that derive at least 70% of their cash flows from the direct operation of infrastructure assets. One of the key benefits of this particular ETF is that it really provides liquid access to the space, which is particularly notable as direct investment in infrastructure is somewhat infamous for being challenging, to say the least, in terms of liquidity. So ZGI offers a very liquid way to enter the space and have exposure that provides the benefits of direct infrastructure investment, but in a one ticker vehicle. Another vehicle that we offer is the BMO Brookfield Global Renewables Infrastructure Fund with the ticker GRNI. And that particular fund is focused on global renewables and sustainable infrastructure companies with a responsible tilt to ensure that that they're being managed, the underlying companies are being managed responsibly. And so, after what we discussed previously regarding the tailwinds at play in terms of moving towards more climate friendly world through increased focus on renewables, we really feel that this particular vehicle will be a real boon for investors, GRNI. And then one more ETF that we offer is the BMO Global Real Estate Technology Fund with the ticker TOWR, Tower. And so that focuses specifically on a global approach to investment in real estate and technology. So that's 3 different angles on infrastructure investment available to investors now.
Yep, and you got that active versus passive decision there too, with the ZGI being the passive exposure and Tower and Green Eye, as I call them, actively managed by Brookfield Asset Management. And
something for everyone, yeah.
These on those, I'll just highlight ZGI 55 basis points and the other 2, Tower and Green Eye, 80 basis points. All right, Vish, and just to sort of wrap things up, I'd love to just get your overall thoughts on the outlook for infrastructure.
Well, I think the outlook is, if it wasn't clear already, I think it's very, very bright. There are a number of factors that are driving the outlook for infrastructure investment. Certainly in North America and in much of the developed world, we have aging infrastructure. Much of it is aging and in need of repair or replacement. Just looking at the United States alone, the American Society of Civil Engineers estimates that the U.S. needs to invest $4.5 trillion in infrastructure over the next decade to renew its aging infrastructure. So certainly no small sum, and that's why initiatives like Biden's Build Back better is, a welcome initiative that we hope, pays off. Population growth, globally speaking, it's expected to grow to 9.7. The population is expected to grow to 9.7 billion people by 2050, and that's certainly going to be putting a strain on infrastructure in many countries. And if you look to the emerging space, so moving away from developed to emerging markets, looking at India, for example, the IMF, the International Monetary Fund, estimates that India needs to invest $1.4 trillion in infrastructure over the next decade to meet the needs of its growing population. So, this is a global, trend. This either a renewal of aging infrastructure in the developed world, or often in many cases in the emerging world, outright brand new infrastructure investment to cope with the rapid urbanization happening in those places. Climate change is another key factor that has been and will continue to drive substantial investment and growth in the infrastructure space. So that's driving substantial investment in, particularly in green infrastructure, i.e., environmentally friendly infrastructure. And if you look at other initiatives too, many countries need to invest in flood control measures and other renewable energy infrastructure in order to attempt to mitigate the effects of climate change and also meet the ambitious net zero targets set by the Net Zero Initiative. And then lastly, I would say also, when you look at the recent technological advancements over the last couple of decades, that's creating brand new opportunities for infrastructure investment that should be a supporting factor in growth opportunities in the infrastructure space going forward. So this, increased interest in investing in smart infrastructure, as we mentioned, right, how AI is being used, right, in the infrastructure space. And again, given the voracious appetite that the world has for being interconnected in every respect, that will require ongoing renewal of the telecommunications and digital infrastructure. Witness the 5G movement, for example, and who knows what's coming next.
Perfect. No shortage of compelling reasons to consider an infrastructure ETF there. So thanks for that, Vish. That caps off another great week of ETF Market Insights. Thanks again for joining me, Vish. I hope you come back soon. I appreciate all your insights on the infrastructure topic.
Thank you. My pleasure.
Next week on ETF Market Insights, I will be joined by Jennifer Lee, Managing Director and Senior Economist at BMO Capital Markets. Jennifer does a great job of breaking down what's going on in the economy in an entertaining and easy to digest manner. So I'm really looking forward to chatting with her next week. I hope you'll join us then. Bye for now.
Thank you for watching this week's episode of ETF Market Insights. To stream any previous episode of ETF Market Insights series, please visit youtube.com/ETF Market Insights. Remember to hit subscribe and sign up for alerts so you know when we post new content. Also, we invite you to visit our accompanying website for ETF tools, education, and much more at etfmarketinsights.com. Once again, thank you for watching. The session provided is for information purposes only. Any reference to a particular company or product is for illustrative purposes only and should not be considered as investment advice or recommendation to buy or sell. Particular investments and/or trading strategies should be evaluated relative to the individual's investment objectives, and professional advice should be obtained with respect to any circumstance.